Okay, let's get started. So, first of all, let me share the PowerPoint right here. Okay, so can everybody see the PowerPoint in front of them? I'm assuming yes. Can you all hear me okay? Hopefully. Okay, feedback, wonderful. Okay, so welcome to this webinar for trade planning and analysis. And as you can see, I put there the subtitle of practical education. And that leads me on to my next slide. So, as always, before we do these things, we have to do a little bit of a disclaimer. And that's to say that the content of this webinar is not investment advice at all. It's going to be used purely for educational purposes only. And all participants are advised to seek their own counsel prior to investing or entering into any trade. Ultimately, what we're trying to say here is that we're going to give you some ideas on how to go about looking at the markets, how to paint a picture for yourselves of the markets, but you know, the ultimate decision to pull the trigger or to take any trade or not is down to yourselves, and you all need to go away and do your own due diligence before jumping in there with both feet. Okie dokie. A little bit about myself. I'm the co-founder of a website called Traders Corner. I founded that with my brother, Alex Ong. And as you can see here, we pretty much do everything together, including trading the markets. Written a couple of books, been quoted on a few websites. We do a lot of coaching. We do, have some videos and all of that kind of stuff out there. And of course, we do these webinars for FX Street. So if you want to find us, you can hop along to our website and take a look there. If you want to follow me on Twitter, you can see the Twitter handle at the bottom there. Okay. So that gets that out of the way. Now let's get into the meat of the session. So I'm going to get rid of that and I'm going to share a chart. Can you now see the chart in front of you? Can everybody see the euro-dollar chart in front of them? It may not look exactly the same as your euro-dollar charts, but this is my version anyway. This is a range chart, and as you guys know, if you've been watching the webinars for a while, I love my range charts. I just think they're so pretty, and they make trading a lot easier. Now, what we're going to do today is we're going to go through each of the charts, or as many of the charts as we can get through, and I'm going to take you through my thought process of what I do when I'm trying to plan the trades. Now, there are a lot of instruments here that I go through, so I'm going to ask you quickly up front, do you want to purely spend the time here looking at let's say, the longer term charts, or would you like me to allocate some time to look at the shorter term charts? I mean, I guess the shorter term charts will be of less help for you now, but they'll give you an indication of how we go over, or how my brother and I go about our day trading, and we'll show you the stuff that we've done today and over the past couple of days. Okay, so we'll have a combination of both. So what I'll do is I'll spend 15 minutes going through this chart, the longer term chart. So then we'll hop over to the shorter term chart. We'll talk about those, and then at the end I'll open up the floor for any questions for a sort of Q&A session. Okay, wonderful. So how many pips are the range bars? First of all, at the moment I've got the longer term charts on the 45 tick range chart. I used to have it on the 50, but the problem that I was finding is that I wasn't getting a lot of price action with some of the less volatile pairs. 50 was sort of quite a bit of movement to expect from them. So just jump down to the 45. And as you guys know, I'm not sort of like a scientist the way I go about these things. I'm very much a visual person. So if the chart looks aesthetically pleasing, then we're good to go with it. And these charts have been working out so far, so we'll continue. All right, so when I come to the charts, I'm a trend trader. I look to trade the swings within the trend. So the first thing that I always need to have when looking to trade a chart is I need momentum, okay? And I need there to be some sort of a trend in place. Now, what I've got here is we've got 3 moving averages on the chart, okay? Now, the 3 moving averages, you don't have to use them. You can use the price action, the pure price action, but we have found in the past that just by using a couple of moving averages, it does tend to keep you out of some of the not so great trades. It's going to cause you to miss some of the great trades, but unfortunately it swings and roundabouts. So you need to make a decision for yourself whether or not you possibly want a lower strike rate, but you want to catch all of the moves, or you're happy with a higher strike rate, and you will have to sit by and watch some moves pass you by. And that's a personal choice. That's not a choice I can make for you. So as I said, we're looking for momentum, and we're going to use the moving averages to help us define whether there's momentum in the market and whether there's a trend in the market. We use exponential moving averages. I've got the 20, the 60, and the 100 here. All right, so we've got the 20, 60, and 100 moving average, and we're on the euro-dollar chart. Now, as you can see, they've been messing about for a little while. We've just since had momentum to the downside, and the moving averages are starting to pull away from each other. Now, once I've got that, once I've decided that the chart is worth giving a second look at, I'm then going to use some of the technical tools. And the technical tools that we use really and truly are things like support and resistance, horizontal lines of support and resistance, that guy there, and maybe some Fibonacci's and some trend lines. So get in some Fibonacci's here like so. And this is where the price is at the moment. Now, what we like to see is, we do like to see a confluence of levels. We would never ever trade Fibonacci on its own. We'd never take Fibonacci level in isolation. That's just, again, our personal preference. The strongest technical tool for ourselves is the horizontal line of support and resistance. So we're looking for price to pull back to these levels of support and resistance. If we have a Fibonacci retracement level that comes in conjunction with that particular line of support and resistance, perfect. That makes it a lot better. But if it's not there, it's not a problem. As long as, and this is the biggest thing, there must be a previous level of support or resistance to trade from. If you don't trade from those levels, it's a little bit more aggressive. I'm not saying it doesn't work out, because it clearly does. But if you want to take the higher probability trades, these are the ones that you're waiting for. So with the euro dollar at the moment, we've got momentum to the downside, which is wonderful. We've got a level that we're looking at. So what we're looking for here is we want price to start to bounce up towards this level, the 2422 level, as a previous level of support, which then acts as resistance. When the market comes up to this level, we're then going to be looking for the market to turn over. Now, we're not looking for it to be pip perfect. It's impossible. It's not impossible, but if you're looking for pip perfect levels and moves, and you're going to be waiting a long time in between trades to be able to get the right trade. We're just looking for the market to come up to a level and show us and indicate to us that in actual fact it is going to take notice of this level. So we want it to come up to this level and in or around that area, and that means sort of 12400, 12450, that's fine. Just around that area there, we want the market to start to pace in respect to this level. If when it gets to this level, it starts to roll over and we get either sort of like a trend line break or price action reversal at that level, then we'll look to take it short at that level, at the 12420 or somewhere around that level. Does that make sense to everybody? So as you can see, at the moment there isn't really a trade on the euro dollar. At the moment, all we're doing is we're waiting for the market to show its hand. Right now, we've got momentum to the downside. If we try to get into the trade now, we're going to be late to the party. So what we want to do is we want to see ideally, we want the market to get through this level, the 12280 level. It's past it now, but if we could get maybe somewhere down to like the 12150 and just let the market prove to us that it's over that level and it's not bouncing off of that level, and then give us a pullback to this sort of level here, we'd be very, very happy to take that trade. What time frame would this equal? This is somewhere between sort of like let's say a 4-hour chart and a 1-hour chart, Boyke. Okay. Ultimately I looked at it to replace the 4-hour chart, but sometimes the moves happen a little bit quicker. So you're somewhere around the 4-hour chart with this. But as you know, they're range bars, so you can't time these things. When there's momentum in the market, there's momentum in the market. Yeah. Okay. So at the moment, the market's breaking down. We're going to wait for it to come back to that level. So we're all happy with what we're doing with the euro-dollar chart. Does anybody have any questions about the euro-dollar chart there? Are you guys sort of understanding what we're trying to do here? We're trying to build a picture. So the first thing that we looked at here is we wanted to see momentum in the market. We wanted to see a bias. We have a bias. If we go back in the chart, we can see that we've come all the way down from 134 and actually beyond that. And we're down now to 122. So it's come 1,200 pips, which is, a very bearish sign. We've got momentum in the market. We then look to identify areas where we would anticipate price turning around. Now, the important thing to remember here is that we're not going to just enter a short when price approaches this level. We can only react once the price shows us that it's paying attention to this level, okay? We're not looking to guess here. When you try to guess as a trader, that's when you get caught out. So what all we're doing here is we're putting in levels where we would expect price to react. If price doesn't react to that level and it breaks through that level, there's nothing we can do. We have to leave it. That's no longer a trade. However, if price starts to react to that level, then that's giving us a clue that the analysis that we've done now, whilst we're out of the market, whilst we don't have any money in the market, all of this analysis seems to be good analysis. If the market comes up to this level and starts to react, that means it is paying attention to this previous level of support, which was support here, support here, support here. It's paying attention to that level. And what happens at levels of support and resistance? The bulls and bears battle it out. The last time the market got down to this level, it sold through it. So we knew the bears won the battle here. The next time the market comes back to this level, all of the guys that sold from here before will be selling again. And anybody that maybe might have missed that move will also try to sell again. So the next time we get to that level, if the market starts to turn around at that level, we can be pretty confident that the market's then going to carry on and sell down. Okay, are these all fib levels? No, these are the Fibonacci retracements I've got in here, but this is just a level of previous support which we're anticipating becoming resistance. Okay, so that's that for the euro dollar. Let's take a look at the pound dollar chart, see what we can find there. The pound dollar is a little less clear. I mean, for me, there are better trades on the table. If I'm looking at this chart here, I'm saying to myself, to be fair, we are now at a level of support. The market has to break through this level here and break through it with some momentum, not just sort of poke through. It needs to break through this level of momentum before we entertain it. With the pound dollar, really what I'm thinking here is if we break through this level, we're then going to be waiting for a pullback to that level. So ideally, we want a break to bring us down somewhere around here. So the market have enough momentum to drop sort of 200 pips from that level, and then a pullback to that level. And then we're in the same situation as we had with the euro dollar. The moving averages will be lined up. We'd have a nice big level of previous support becomes resistance to trade from. And all of our stars will be aligned. But at the moment, for me personally, I can't see anything worth trading on this chart here. So I would literally move along from here. So let's do that. Let's move on. Let's look at the dollar CAD again. The dollar CAD is by no means an oil painting right now. It's disgusting. I would struggle to love this chart. There's absolutely nothing here for me. So let's move along again. And this is what your trade analysis should be like, guys. You should look at a chart and you should know instantly whether it deserves any more attention from you or not. I mean, this dollar yen, horrific. What are you going to do there? Are you going to short? I doubt it. I mean, it's not clear price action to short. If you short, you're going up against the BOJ. There are better trades. And remember, we're here to make money, guys. We're not here to entertain ourselves or do anything like that. So we want the high probability trades. And trading up against a central bank does not represent high probability to me. What about the Australian dollar? Is this going to, okay, now that looks a little better, doesn't it? So what are we thinking here? Well, first of all, we have a trend. We've got higher highs and higher lows. Wonderful. What else do we have? We've got the moving averages lined up. We've got clean price action. What's going on at this level here? Let's take a look. So we've got a previous level of resistance here, a little bit of support there, minor support there, and the market is at that sort of area. Now remember I said to you guys that we're not looking for pip perfect. We don't care. It doesn't have to come directly to that level. It just needs to react in this area here, and it looks like we're getting a reaction there. So if we then get the signal to enter, then we'd be looking to take that long. So this is a particular chart that we would have our eye on. Okay. Any questions about this at all? I mean, it looks as clear as day to me. If we put in a Fibonacci retracement level, I'm pretty convinced we're going to have like a 50% there or something in that region. 50% up. 50% level right there. Okay. Any questions? Does this look like a good chart to the rest of you guys, or is it just me? Am I being biased there? You see we've got resistance, played with it here, broke through, came back, played with it here, played with it again. It's a good level to trade from. Upwards trend, previous level of support become resistance. If we can just get the trigger here, which we almost got on this candle, if we can just get the trigger, then we'll be taking that long. Harley, yeah, we've got the pullback here. This is the pullback. All we're waiting for now is we're waiting for a positive trigger that give us the indication that we're allowed to take this long. And then once we take this long, you're in there and you're looking to make your money. Let's take a look at the New Zealand dollar. Pretty much a carbon copy of the Australian dollar. Not quite as beautiful price action, but still an uptrend all the same. What's the trigger? I mean, you can look for different things, try and trade. I mean, ultimately, if you're trading a time-based chart, we would be looking for a trend line break or 1, 2, 3 reversal. Have you heard of those before? Like an ABC reversal pattern? That's the sort of thing you'd be looking at from, yep, excellent. Okay, so they're the sort of price action entries that you're looking at on your charts, okay? Like a trend line or a counter trend line break or some sort of a price action reversal pattern. Generally, what you feel most comfortable with. If you're quite comfortable trading candlestick patterns, then by all means, please go and do that. Me personally, I've never really got on board with candlestick patterns. I can see them, I can understand them. I feel more comfortable trading other things. Looking at the New Zealand dollar, okay, we've got pretty much the same thing here, albeit not as pronounced as the Australian dollar. But if we see we've got an uptrend here, we've got the moving averages in the right direction, which is nice. We've got a previous level of support of resistance here, okay, which is now acting as support. So what we're looking for is, when you talk about triggers here, we'd be looking for a positive close of the candle. We've had one. Generally, we like two, just to give us additional confirmation. And then combined, we'd look for the stochastics and the CCI to also line up and filter out the crud, so to speak. But yeah, at the moment, this also looks like a good trade. So far, what have we talked about? We like the euro dollar. The pound dollar has to give us more momentum before we're looking to enter, because, you know, the euro dollar is a better trade than the pound dollar. They both look nearly the same, but the euro dollar's got a lot more momentum. We also like the Aussie dollar and the New Zealand dollar. We're just waiting for the right triggers there. Let's jump onto the dollar franc and see what that has for us. Okay, so this is also a nice looking trade. The only problem that we've got here with this trade is that we don't really have a pullback. Now, this is similar to the pound dollar as well, in the sense that we're actually at quite a major level. So we've got to make a decision for ourselves. Are we happy for the market to pull back down below that level? And if it pulls below that level, we're looking for it to react to the chart here. Or do we want to see the market completely clear this level, so pull up to somewhere like this and then pull back to that previous level? If you're looking for the higher probability trades, really you're going to be looking for that price action. If it pulls back here, if you're feeling more aggressive, if you're more of an aggressive trader, you'd look to take that long. But in reality, for me, I would like to see more momentum up here, maybe look to go towards parity and then have a pullback to that level. And then after that pullback, then give us an indication to go long off of a bounce from this level here, because that looks like that's the year high. So it's a pretty strong level to take a bounce off of. If we take a bounce off of this level here, what are we doing? We're trading directly into resistance, and that doesn't represent a high probability trade. Okay, we're all about high probability trades here, and what this level represents to us is a speed bump. And we don't like trading into speed bumps because they give us issues. We want to trade into fresh air, okay, into just clear blue skies. So we want to see for the dollar franc, we want to see it come above here, somewhere up to sort of this level here would be a nice move, followed by a pullback down to that level. That would represent orderly price action to me. Once we get a pullback to that level, then we'd be looking for a bounce from that level. Okay? So, does that make sense to everybody? Does anybody have any questions about that? Or how we go about that, the thought process? Because more than anything, what I want you guys to get from this, forget the trades that we've looked at, forget the 7 charts that we've looked at. I want you to get the mindset of what you guys need to be doing when you're planning your trades. Okay, it's not about sort of putting your finger in the air and just thinking, yeah, this looks like it's going up, I'm going to take this. Okay, what you need to be doing when you're trading is you need to look at the chart and it needs to tell you a story. And if we don't like the story, we don't trade that chart. We move on to the next one. There are many, many instruments that you can trade. And once you see a chart that you like, then you start adding all of the little bits of support and resistance, and you start to build the framework around your trade. So that ultimately what you want to do is you want to get to a point that by the time you get into your trade, you've done all of the planning that you need. So there's nothing left up to the imagination. Okay, so let's say, for example, let's take this one here. What I've done is I've said, okay, I want to see momentum up to around the 100 level or somewhere around there. If we get momentum up there, followed by a pullback, I'm then going to look for one of my entry triggers off of the 97.70 level, okay? Or in or around, give or take 10, 20, 30 pips, not really bothered. But somewhere around there, we're looking for a trigger to enter into the trade. If we get that trigger, I know that my stop goes below the swing. That's where my stop always is. I also know that I'm going to look to take some of my profit off the table before I get to that high there, if I can. Okay, and then I know that I'll possibly leave someone, or I'll make the plan depending on what's going on in the markets, what the fundamental view is, to hold some of the position, to look for the bigger move. But do you see what I've done here, where I've ultimately said that I'm going to do this, this, and this if the market does X, Y, and Z. So I've already laid out all of the criteria for what I'm going to do in that trade. So when that trade comes, there shouldn't be any thinking involved. You know what you have to do. Now your job is execute. That's all it is. You have to do absolutely nothing else, because whilst analyzing your charts, you've made all of the decisions. And once you can get to that point, you'll be closer to being able to sort of, I don't know if trade like a robot is the right term, but ultimately get rid of your emotions and just execute. Okay? Do other time frames need to be in line for you before you take the trade? They don't need to be in line in the sense that they need to be trading in the same direction, but you do want to look at longer term time frames for the bigger levels. So let's say, for example, we're looking at this chart here. I would look at also, maybe a daily or a weekly time frame to see if I take this long from here, am I going to trade into a brick wall that maybe I can't see on this chart because I can't get enough perspective, because I can't go far enough back in time. But if I look at something like a daily chart or something longer, then I can see, a very big level. So you'd look at those charts from a perspective of wanting to know what you're trading into, but you wouldn't necessarily need them to be in the same direction in order for you to be able to trade. But obviously that's a personal preference. If you felt more comfortable taking less trades, but only waiting for the trades where everything sets up, then that's fine, because no two people are the same as traders. You've got to find what works for you. What I'm trying to give you guys here over the webinars that we've been talking about, over the stuff that we've been doing, what I'm trying to give you guys is a framework to be able to conjure up sort of a trading system that works for you. Okay, so off of my soapbox, as Boyke like to indicate there, to the shorter term now. So let me stop sharing there. All right. Hello. Can you guys all see the 8 range chart in front of you? Excellent. So let's talk about the shorter term stuff. The shorter term stuff is very much the same as the longer term stuff. We're looking for the the same sorts of level, the same sorts of interaction. Okay. Now, as you can see here, let's go back to yesterday's trading. Yeah. Okay. Where are we? So we'll show you a couple of the trades that we took yesterday and the trades that we took today. Okay. So coming to the market yesterday, we saw that we woke up, we were already bearish on the euro because of what happened on Thursday and Friday. So we're looking for some downward momentum. As you guys know from some of the previous webinars, we only start trading at 8 o'clock, from 8 o'clock in the morning UK time. So all of this stuff here, we're not able to trade. When we came to the markets, we had our eye on this pivot point here, okay? And this previous level of support becomes resistance, okay? So we've got support here, we've got resistance there. And if you take that down there as well, you can see that we've also got another level of support, which then became resistance. So you've got this guy here and this guy here. So ultimately, we were looking for a bounce off of that level, all right? We got into this trade yesterday morning at about 9 o'clock. What time is it? 9 o'clock? 8:53, okay? So we're in that trade at 8:53. We took this trade down to this level there. We were looking for about 2 to 1. All right, the market bounced off of this level, it pulled back, and that came to within about 2 pips of our profit target. All right, once it got within 2 pips of our profit target, we didn't. What time frame is this equal to? Roughly, you'd be looking at somewhere between a 5 and a 15-minute boy key. Okay, you can kind of identify the same price action as you'd have on a 5-minute. So yeah, so we got the bounce off of the level. We traded it down here. We were within about 2 pips of the profit target. The market bounced away. It came back down to this level again, and it started to find resistance again, and we were out there. So we got about pretty much 2 to 1 on that particular trade there. Okay. Then coming back to the markets later on, we had the bounce off of this pivot here. Unfortunately, or fortunately rather, because as you can see, it didn't actually work out. It was at 11 o'clock. So we don't trade at 11:30. We trade from 8 to 11 and from 1 until 4. Okay, the other trade of the day, which we didn't take, it would have worked out, but we didn't take it because the moving averages weren't aligned, was the bounce off of this pivot here. If you're looking for levels of support and resistance, as we said, that represents quite a nice level there, quite a nice level to trade. But as I said, we were looking for the moving averages to be aligned. They weren't. That would have represented a nice trade there. So what you're trying to do on the day basis is, sorry, I've got a question. So you're only trading in the direction? Yes, only the direction of the trend. For all of our trading, we are only trading in the direction of the trend. Okay? So that was yesterday's trading. Coming to today's trading, our initial trade was this one here. Okay, so at 8:22, we get our signal to go short. Why did we take this trade? The moving averages were just about aligned. Okay, but more than that is, again, we had a bias to the short side, and we were bouncing off of off of the daily pivot, which usually represents quite a big trade. We then get into that trade there, 15-minute, yeah. We then get into the trade. The market takes us into a little bit of profit. With hindsight, looking at the way the market reacted to this level here, and the fact that it is also comes in conjunction with this previous low here, perhaps we should have got out. We didn't get out of this trade here, and as you can see, we got stopped out. So that was our first trade of the day. Absolutely nothing you can do about that. It's just trading for you. But then this afternoon, before we came onto this webinar here, we have the market make a massive momentum move to the downside, which is what we like to see. We get a bounce off of S1 here. Once we get the bounce off of S1, we know we're looking for a short opportunity. The ideal place for us to look for a short is on the daily pivot. Because you guys know, if you're below the pivot, you're bearish. If you're above it, you're bullish. So we're looking for a reaction to that daily pivot. It also happens to come in conjunction with this previous level of resistance over here. Previous level of resistance becomes support. We move along. We get to bounce off of that level, and we trade it down to S1, looking for 2 to 1. We got our 2 to 1. The market bounced up a little bit. We missed the 2 to 1 there. And then eventually, when it broke back down there, that's where we got our 2 to 1. And the market has since sailed off into the sunset. But they were the trades that that was the trade that we looked at today. So we started off with a loser, but obviously because we've got a positive risk reward, the second trade of the day, which was a nice trade, gave us profit for the day. So we finished the day up, which is a nice thing. And now I'm on the line with all of you wonderful people. So with regards to the short-term stuff, it's very much the same as the longer-term stuff. The one theme that you guys should take from our trading that myself and my brother do is that we're always looking to trade in the direction of the trend. We're not, there are other ways to trade. You can trade counter trend, but us personally, we trade in the direction of the trend, and we're always looking to trade from a previous support or resistance. We've got our trading down to, well, I say a fine art, but, I can move away from the charts. I can go out to the gym or something, and I can come back. I can look at the chart, and I will know that if my brother's been taking over for me, I'll know exactly where he's gone in, because we trade the same way every single day in, day out. We do the same moves. There's nothing left up to the imagination. And we've only got to that point because obviously we've been doing it a long time, but we did a lot of testing as well. So we understand what makes sense for our systems. We trade from support and resistance levels, and we trade with the trend. And that gives you the higher probability trades, and that is where you will make your money. Okay, I can breathe now. So, does anybody have any questions at all? How have you guys done today? Have you all been trading or? When is our? Yes, we do use stochastics. The trading room we're going into the summer now, Carly, so it doesn't really make much sense to do it now. We're going on a holiday and stuff like that. So we'll probably let me just learn to speak English a second. We will probably, that's still not English, probably, there we go. Probably look to open the room somewhere the beginning of September, if that works for you guys. JD, on a intraday basis, we trade only one instrument, so we don't need to keep an eye on many. For the longer term basis, you have so much time that, as you just saw, we managed to look and analyze 7 charts at the beginning of this webinar in the space of about 10-15 minutes. It's actually quite good that you bring that up. This is my recommendation to you guys, okay? If you're looking to day trade, try not to look at so many pairs. You don't need millions of pairs, okay, to allow you to be successful. It's much better just to choose one pair or one instrument and really get to know that instrument, become a specialist on that instrument. Because if you're day trading and this is the time frame that you're trading, there are more than enough opportunities within a month to be able to make you money. If you start looking at millions of pairs on an intraday basis, you always find that you're missing the good moves, you're jumping on the moves which are bad, and it doesn't do a lot for your health. Let's put it that way. Okay? We use the CCI and the stochastics for our confirmation. So stochastics, as you can imagine, we're looking for a cross. And the CCI, we don't want it to be an overbought or oversold territory when we enter. Harley, no, we don't don't just trade FX. I mean, we literally trade anything that moves, but primarily FX. So have you guys been trading today? Doing well? I recognize a few familiar names from the past webinars. Have you guys gone away and done your back testing as we talked about on our last webinar? Demo's fine. If it helps you to understand your trading system, there's nothing wrong with demo. So when I asked about the back testing, no one replied. I'm glad you guys all took it in. Thank you. I feel so loved. Do we have any questions at all about the charts, life, Father Christmas? Do I switch from higher to lower? Are you talking about higher to lower time frames? If you're trading a time-based chart, then yes, you can. Okay. Pink elephants, I'll come to pink elephants in just a second. If you're trading time-based charts, then yes, of course you can go to a lower time frame, or if you're looking for a faster entry. Trading the range charts, no, we generally just sort of trade the chart that's in front of us. About those pink elephants, haven't seen any lately, but I'll keep my eye out. And Sonny Claxton. Have you seen pink elephants, David? What are they? They're big creatures with big ears and a long sort of nose. And they're pink. Only in the UK. Yeah, mine too. Okay, guys. Well, I think if there are no more pink elephants in this room, and you guys don't have any other questions, this is getting out of hand now. If you don't have any other questions, then I guess we can wrap it up. We're doing another webinar on Thursday, I believe. Is that correct, my friends at FX Street? Thursday at time 12, 1. We're doing one on Thursday anyway, and we're going to talk about support and resistance and how you can use them, which should be quite a good webinar. As I said, I mean, support and resistance really is everything. It's to us and for our trading, we couldn't trade without support and resistance. So I really recommend that you guys come and join us on that webinar over there. Thank you, Boyke. 12 p.m. GMT, so 1 o'clock UK time. We're going to be doing it on support and resistance. So I hope to see you all there. If you guys have any questions, as always, please feel free to ask. Send me an email or send it to the guys at FX Street, and they'll make sure that I get it. Otherwise, shall we wrap up here? Mordor Adinda? Thank you very much, guys. Excellent. Well, thank you very much, FX Street, for having us on today. As always, it's a pleasure, and it's nice to see you guys. Some of the familiar names I've seen on quite a few of the previous webinars. And I look forward to seeing you all on Thursday. Okie dokie. Take care now.